All right, we're going to begin with looking at the ins and outs, so the ins and the specifics of calculating a return on a calendar call spread. And this comes from Trevor. And Trevor emailed me earlier today, says, I'm trying various option strategies, one of which I think is called the calendar call. I did this because the profit graph that you showed on the predicted profit and loss page looked like a very good return, provided that JP Morgan stayed within a certain range. So on July 9th, I bought a JP Morgan 2021 June 90 call for $14.08 and sold a 31st July 2020 call for $4.22. So on July 9th, one was 22 days away to expiration. The other was about 395 or 400 days to expiration to the 18th of June 2021. I think it was 392. Now, his question continued. He said, I decided to close it out today very perplexed because the profit and loss graph indicated that the profit around $300 with JP Morgan trading at 98.40, which is where the stock was this morning, and I think it closed at about 98.20, 98.30. However, all I made was a measly $80. Never in this trade did the real-time profit, I was regularly monitoring the position, came anywhere near the predicted profit from the power options profit and loss chart. Can you explain this discrepancy? Yes, I can. Here is the position as Trevor entered it. All right, let me change that color. I am not going to use a pink pen. Sorry about that. All right. And as you can see, the max profit listed here is around $510 if the stock was trading right at 93.50, the sold call strike price at expiration. And as you mentioned, the stock was at 98.49 today, and the profit is right around 320, 325 based on the profit and loss chart. Now, this is a cheat. This is looking at the profit and loss chart as sort of Trevor entered the position. That'll be explained in a moment. So why today, when he was closing out this position, was his profit only here at the $80 range instead of up here when he originally entered the trade, and even if it was trading in this range before July 31st, but even close to it, only 7 days away, was he only receiving $325? Are we doing the wrong thing? Are we doing the wrong calculations? Not at all. When you're trading these types of strategies, anything that's a time strategy, and this relates even to a radioactive trade where I've got an 8-month output and I'm selling a near-term call against it and I'm analyzing this profit and loss chart. Or you're doing double diagonals. Anything where two options have a different expiration field, you need to remember a few things. This issue that Trevor experienced is related to a few factors. The big one is he traded the position around an earnings event, which caused an IV drop on the short option in his favor, but also on the long option, which changes the expected value. And that's what the tool uses. The June option is trading well below its theoretical price related to the 50-day volatility. There's also a lag in the leap price, and for these types of structures, there's the effect of what's called the near-term delta effect. These are all the factors that came into play. Here is the position. He opened it on July 9th. Earnings were on July 14th. The short call expired on the 31st. Long call is out to June 2021. On the day he opened the trade, JPM was at 91.28. The July 93.50 call had an implied volatility of 0.5076, about double its average, 2/3 greater than its average. And that was high due to the earnings event coming out before the expiration, 17 days before the option expired. Now the June 90 call out to 2021 had an implied volatility of 0.4203, which is also near its high over the life of the option due to the upcoming earnings event. Underneath that profit and loss chart on power options, there's a field there where you can calculate the profit and loss at expiration. And this is what we were seeing, and this is what the tool was using. It's a little bit different now because this volatility was at 0.57. It doesn't matter. But we see here, if we looked at the stock trading at 93.50 for that position on July 31st, the expiration, Our short call would go to 0 and we'd have the full profit, and our long option would be worth $16.20. If and only if the implied volatility stayed at 0.4203, which is not likely to happen after the earnings. It's going to drop back to its lower range, even the leap option. Not just the short terms, it's going to affect all of them. Okay? When you're analyzing any type of time spread, what the profit and loss chart, that custom spread tool in Power Options does is it has to use the Black-Scholes pricing model to determine what the theoretical value of the farther out option would be if the stock was trading at any price at the nearer term expiration date. As we saw, the max profit for JP Morgan was if it was trading right at 93.50, the strike price of the short call, on July 31st. Didn't have to buy it back for any intrinsic value. But this again assumes that the implied volatility of the long option remains the same. 4 to 5 days after that earnings on July 14th, the market was also rising and things were calming down a little bit. The IV of the long option fell to 0.366. Does that seem like a big decrease? No. But look at the effect it would have on that leap call. From 0.4203 to 0.366, if the stock was trading at 93.50 on July 31st, the option wouldn't be worth $1,600. It'd only be worth $1,438. Okay, missing about $200 or so with just that small drop of 0.06 in the implied volatility for the far out option. Okay, that is one of the reasons that happened. You compare directly, 1620 if we kept a volatility of 0.4203, if the stock was trading at 93.50 on July 31st for that leap June 90 call. And if it's at 0.366, we're down to 1438. So it's about $180 difference. Okay, well that explains maybe $180 because we didn't take into account the implied volatility, but that would still mean a profit of 170, 160 or so, not $80. Okay, why is the difference still large? Well, another reason is not only the implied volatility. 4 to 5 days after the earnings, it was at 0.366. Earlier this morning, it dropped down to 0.312. Okay, so that also changed the factor. But look at the difference. You'd say, wait, well, it's still showing a value of 1585. The stock today was trading at 98.50. Well, on the 27th, the expected value a couple days away on Monday, on July 27th, of course. Here we are at 98.50, the current price of the stock. We've got 507 to buy back the 93.50. That makes sense. It's intrinsic value. But the 90 call, that's $8.50 in the money, would be priced at 1585, which was right about the actual trading price of the option, only a gain of $177 with the implied volatility falling because it's getting deeper in the money. But we have to take into account the possibility. So when you're doing any kind of time spread around earnings, when an option expires further out in time, when you see the listing of the option in the details of the custom spread tool or on your search, you want to use that more information button. You need to go to research and option research. This shows you all the available data that we have for that option. And over on the right, you'll see the implied volatility in the total range. So when he was analyzing this position, when Trevor was looking at the profit and loss chart on this position, the current volatility was 0.42. So when I went into the custom spread tool, what I would have done is run what the profit and loss on this time spread would be as we got closer to the near-term expiration. What would my leap value be if the implied volatility dropped back down to the lower range, the worst case scenario, back to 0.24? It might actually show a loss in that case. Or if it went into the middle range of where it is right now in the low, which is where we are, around 0.31, 0.32 during the day, and it went up to 0.36. What else is interesting here? This option right now has a delta of 0.61. It's 8 points in the money and about 380 some odd days to expiration. Why did I highlight that here if we're talking about the implied volatility and making sure that whenever you're doing a time spread, you look at the true range of implied volatility and calculate what the long option would be worth in that scenario if it went back down to the low, or if you're expecting IV to rise and it goes up to the high. For example, if you sold an option and it could go back to the high, it would cost you more to buy it back. You want to analyze that as well. Why I was showing delta is because of the delta effect of these calendar spreads, what we sometimes might refer to as lag. As we get closer to expiration, remember we opened this position, the stock was at 91.28, now it's at 98.50. That July 93.5 call that's in the money by about 5 points, but has 7 days to expiration, has a delta of 0.86, getting closer to 1 as we get closer to expiration. The 90 call, which is out to June 2021, 380 some days away, which is more in the money, it's in the money by $8.50, only has a delta of 0.61. Typically when you open a calendar call or diagonal call spread, you open it with a delta ratio of, say, greater than 1.8, meaning when you opened it, this slightly out of the money delta was probably 0.4, or maybe even 0.35, and your more in the money delta is probably at 0.7 or 0.8. So the long delta divided by the short, you probably want a ratio of around 1.8 or so. As you get closer to expiration on the diagonal call spreads or the diagonal put spreads, your near-term option, if it's in the money, is getting to 1 delta faster. So now every dollar the stock moves up, you're losing more on the short, which you have to buy back, than you're gaining on your long. And that's why on the calendar spreads, we see the tail off from the peak, because this delta of the short, that's your obligation, is going to 1 faster than the leap option as well. Okay. Now, if I started off with a delta of 0.86 and was deep in the money, say at the 80 strike for JP Morgan at a much higher price, maybe the deltas would be balanced out. But in this case, with a cheaper delta, strikes only a little bit apart, short option delta is massively overtaking the long option delta. And this is another term that we use when talking about calendar spreads, the lag. You don't see the leap option typically react as fast. So if the stock moves up 5 points today, the option that I have that expires in 7 days or 10 days, I'll probably see an immediate increase of 4.5, 5 points directly, because we're getting way too close to expiration and the delta is getting closer to 1. I might only see a gain of $2.50 or $3 on the leap option. It lags a little bit. It takes some time. Okay, so again, JP Morgan was at 91.28. He was able to sell the July 93.50 at 422, which was inflated because of the upcoming earnings. June 90 call was at 1408. That was $1.28 of intrinsic at the time and $12.80 of time value, extrinsic value. JP Morgan closes around 98.30, 98.20 today. The July 93.5 call is pretty much near intrinsic at $5, maybe 20 cents more, 20 cents above intrinsic in that case. The June 90 calls at 1605. That was a closing price, I believe, at 412 is what I saw. Okay, so we saw a $7 increase on JP Morgan from 91.28 to 98.30 over the last, 18 days. My apologies, 18 days. But the leap is only up $2 from the purchase price of 1408. Part of that is due to the implied volatility collapse that we saw. Even only the 0.06 from 0.4203 to 0.366, but it's actually as a 0.32, 0.31 during the day. And that caused enough to saturate out the $200 or $300 we'd expect to have in here because the IV fell. And that's where the lag comes into play, with the delta also in that case. Okay. All right. So important notes here, we want to look at this, the important notes when doing multiple expirations, okay? When doing multiple expirations, know that the tool, the profit and loss chart, is using a theoretical value based on the Black-Scholes pricing model, which is what any sort of options service or profit and loss chart is doing. It has to say, we don't know exactly what this option is going to be because there's going to be time value. We have to calculate that using these theoretical pricing models. Those are based on implied volatility of the current option. which can change based on any events coming up in the future, change in market sentiment, fear being driven in the market, which might work in your favor if IV increases. But of course, if it's dropping, say off the peak that we had in March, that's going to lower the prices of long-term options. When you're looking and analyzing a time spread on the profit and loss chart, use that link I showed you to go to the research tool for the option, see the total implied volatility range. Use the low in that calculate feature to see how if it does drop to the low again, how that's greatly going to affect your position, or use the mid to see the expected gain or loss as well, so you can determine if IV stays the same, this trade looks really good. If it falls a little bit, am I still happy with the return? And if it goes down to its low, is this a trade I would even enter? Okay? So the time spreads, it assumes the IV of the long option remains the same, but again, we know that's not going to happen. The IV is going to change, and that's going to change the expectation of the position going forward. That's why you need to check the implied volatility whenever you're doing any type of time spread. All right, we've got a lot of questions coming in. That's just what I wanted to wrap up for Trevor there. We might show an example of that in a moment, but I'm going to navigate over to power options right now. Well, in a second, I'm going to navigate over to power options. There we go. All right, so am I there? Oh, no, bounce back. I'm sorry, folks. There we go. Okay, so very quickly, I'm going to go to the portfolio tool. And yes, I'm going to get to all your questions in just a moment. See them all come in. I'm going to scan through. Actually, before we go into Octavio's question that he sent me regarding managing a position, I'm going to move this over, and I'm just going to see if any of the 12 to 15 comments that came in are related to our discussion right now that we just covered. Okay, so that's different. That's a question from Pat. Okay. Fernando says, the IV increase decrease affect only the extrinsic value of the option? No, Fernando. Remember the lessons that you learned from radioactive trading and from other discussions that we've had. The ATM bell curve. Even though Trevor bought a leap that was at the 90 strike. Okay, let me go back here. Let's just look at the profit and loss chart very quickly from our position that I entered. There's that profit and loss chart again. And okay, the volatility ended at 0.3305. Okay, so still much lower than the original expectation. But the ATM bell curve, Fernando, remember, it's not that it affects only intrinsic. Think about it this way, Fernando, if the stock stayed at the exact same price and only volatility changed, then we could say that, yes, extrinsic value is affecting it. It's affecting the extrinsic value. It's affecting the price of the option, but in this case, we're in the money, so we have to take that into account. What do I mean? Okay? Let me redraw that. The ATM bell curve, Fernando. That simple thing, it says at any option chain, at any time, any expiration, the option that's right at the money is always going to have the highest time premium. Okay, for calls, this is in the money. As the stock moves up, well, this is naturally just stock moving up, and this is stock declining further out of the money. This is OTM. So this position, he was about even. He opened the near-term 93.50. That's terrible. Sorry about that. And bought the 90, which was pretty close to at the money. So at that time in June, that had the highest, near the highest intrinsic value, because out of June, it's just 5 strikes for Fernando, 90, 95, 100. So this had the highest time value of all the June options. That's not to say his structure was wrong. What I'm saying is now, if the stock stayed right at 90, 128 and implied volatility increased, we'd expect this price of the option to go up, even though the stock's not moving. If IV falls, JP Morgan stayed at 90, 128, it fell. If implied volatility remained the same, Fernando, in theory, what we would see is if the stock went up to 98.50, in this case, that 90 strike is no longer at the money, is it? So the price here is at 98.50. Here's your 90 way down here, okay? The ATM bell curve is talking about the time value only. So you'd actually see the extrinsic value increase, but you'd see the option price increase because it's gaining, of course, intrinsic. And as the delta goes higher, the extrinsic goes lower, and you're getting closer and closer to 1 intrinsic. But if the stock stayed the same, 91.28, implied volatility decrease, you'd still expect to see a decreased price in your option. You're not losing intrinsic, you're losing time decay and extrinsic. And if implied volatility moved up, but the stock JP Morgan stayed at 91.28, you'd expect that long call to increase. So you're sort of gaining intrinsic, but not really. Okay? All right, hold on. Okay, Vince, I see your comments. All right, so I think, okay, good. I think that's all that's related to this, except with the topic that William just asked while I was going through it. And William, I'm sorry, guys, had asked me related to the delta ratio for the calendar spread. He says, could you explain the 1.8 delta ratio for the calendar spreads again? All right. It's something I prefer to use. You don't have to use it. It's one of the 3 factors that I look for, and I took off calendar spreads earlier. So let me put calendar spreads back in, take off Iron Condor for the time being, go to the other strategies tab. Let me add calendar call back in. Okay. Fantastic. All right. So I'm going to go to the general search. I do believe my general search is here. Yep. So as I scroll down to the criteria here, I'm actually looking for a delta ratio of greater than 2.0. All right, what does that mean? Well, in the structure of the option, with 2 different options, William, of course, you're going to have a long option delta and a short option. Again, let's think about the profit and loss chart. We'll just take the first one here, not a recommendation or suggestion. We're going to look at Norton LifeLock. Okay. Probably not the spread I would take. I think the short call is too far out of the money. I'd probably look at a 21 or a 22, not the 23. But in any case, here's what we're seeing. Now, the delta ratio is the delta of the long option that you're buying, here, the 17, divided by the delta of the short. And in theory, I want that to be greater than 1.8, meaning that the long option delta is 80% higher than the short. Why? Number one, I want to give myself upside room, and that gives me a structure with a decent at or more likely 1 or 2 strikes out of the money short call. But it's because if the stock moves up 1 point, yes, delta is ever changing, but I want to start off at a point where if the stock moves up $1, I'm theoretically gaining 80% more on the long option than I'm losing on the short option, which is my obligation and I have to buy back. That's the structure I personally look for. 1.6 is okay too, and I think that's where Trevor was initially at the onset of this strategy, but as it got deeper in the money and closer to expiration, the short option delta started to overtake the long in that case. Okay, so that's what we talk about with the delta ratio. It's the delta of your long option divided by the delta of your short. Long option, I mean the one that's further out in time, but also the one that you're buying. Okay, and let me just add in the columns real quick here. So I click Add, Remove Columns on the search so we can show this a little bit better. So I'm going to see long option delta, short option delta, and delta ratio. Okay, let me increase the full size there. Let's refresh our page. Okay, so let's go over to the far side. So you see here, this is what I'm talking about, William, and you can add those columns in. These are high, these are very high, but at least I'm starting off even with the lower one here down at the bottom, I'm at 2.10, 0.65 long to a 0.31 short. And with a stock at 56.85, selling a 60 and buying a 50, that looks like a pretty good structure. I kind of like where that is in relation to the strike prices there as well. But that's what the delta is. It's the delta ratio. It's the long divided by the short. I prefer to look for a minimum of 1.8, but on some of my searches I have it as high as 2. Okay, but those are starting points. You can put in what you want there as well. Okay. Yeah, it was a debit spread. Sam says, looks like a debit spread on JPM. It was a debit spread. It's a calendar debit spread, of course, as well.